for tuning into another episode of Insightful Principles. In today's content, I want to talk about bearish and bullish markets and looking at the history of when we see downward markets and also when they recover. Oftentimes when we see a lot of market volatility, when we hear recession talks, when we're just worried about the economy in general, oftentimes we can not put things in perspective. And with this video, I want to provide you all with perspective, with context of understanding what we have done in history and what we have to look forward to in the future and how we can properly prepare. If you all can do me a huge favor, like and subscribe and share this video, and don't forget to hit that notification bell below so you can be notified each week when I drop content. So when it comes to the history of bearish and bullish markets, throughout our history we've had about 26 bearish markets, with 15 of those leading into recessions. That was about 57%, and then we had 11 that weren't recessions, and that was approximately 42%. So half of the time throughout history, if we look all the way back to 1928, we have seen more times than none, 57%, it has led to recessions whenever we have been in a bearish market. Now, some of the most notable ones, you all are probably familiar with the Great Depression that happened actually from 1929 all the way to 1939. That was one of our longest and steepest recessions, where 89% of the value of the Dow declined in value over a period of 3 years. We also had in the 1960s and the 70s where the stock market declines were of 36.1% and also 48.2% in the early 70s. And then also one of the most talked about recessions that we had was from 1980 to 1982. It was actually a double dip recession. The first one was in 1980, and then there was also another recession from 81 to 82. And this was when Fed chairman at the time, Paul Volcker, had to raise interest rates to like 17% to get a control of inflation. And a lot of people have been comparing what we have been seeing in the market now to the 70s, whereas some people have made comparisons to more of the 40s as well. And also the dot-com crash, we had that from 2000 to 2002, where the S&P 500 tumbled by 36.8% within 1.5 years. We also had the Great Recession, which was the housing mortgage crisis from 07 to 09. And this was the second largest bear market along with the Great Depression. And lastly, more recently, we had the pandemic, which was the health crisis that was in March of 2020. So we've seen different variations of recessions throughout our history. It's important to keep history in mind because history leads to clues. Of course, history doesn't predict future performance. However, it does context, and it also provides perspective on when dealing with market volatility and knowing how to properly prepare and assess risk when we do see these periods of volatility and also when we see a downturn within the economy. Now, what's important to note is not only the recessions and depressions, but the recoveries and how the market was able to turn around, and how more times than none we see that the market leads more into a bullish period when we look over history. And in fact, bear markets, they tend to be short-lived. And in a moment when you're going through a depression, we've never went through a depression like in the great 1929 crash. We haven't seen anything to the magnitude, as far as me as an adult, I haven't seen anything to the magnitude of the Great Recession. I was getting ready to go to high school when that happened, so I really didn't know what was going on with the economy. But I think what we had in 2020 was a very small, mild, I really don't look at it as a recession. It was more of like a pandemic, but we haven't seen anything to the magnitude of the Great Recession, and even more severely with the Great Depression. Now, the average length of a bear market is 289 days. That's typically about 9.6 months, which is a lot shorter than the average length of a bull market. The average length of a bull market is actually 991 days, or 2.7 years. S&P 500 bear market and recoveries, and it really highlights, the blue lines are the length of the bear market in months, the light blue lines are the decline percentages, and then the orange lines are the length of recovery that it took in months. And this is dated all the way back to 1956. And the three biggest declines that I can see is January of 1973. This was actually the oil embargo recession, which was a decline of negative 48.2%. Then we had, of course, the dot-com era in March of 2000, which was a negative 49.1%. And then we also had, with the Great Recession in October of 2007, was negative 56.8%. Now, if we break down and look at the length of the bear market in months, and then also how long it took to recover, if we go back to January 1973, yes, we did have 21 months of bearish market territory, and it took 69 days, or 69 months for it to recover. And then if we look into March of 2000, it took 31 months of bearish market territory, and then it actually was 56 months for it to actually recover. And then if we look lastly here in the Great Recession, it was 17 months of bearish market territory, and then it took 49 months to recover. And one thing that I'm noticing is it started to decline. The length of recovery that we see with looking at history, it starts to decline. And even when we look at the number of months of bearish market activity with territory, that also declined. Now, of course, from 1973, and then we look into 2000, that bearish, the dot-com era, it did last a little bit longer with that recession. However, if we look more recently with the Great Recession, it was only 17 months. So that was only about, a year and 5 months. And then it ended up eventually recovering. So I say all of that to say, if we look at history, the market is starting to recover a lot faster. Even if we look here more recently with the pandemic, we had 1 month of bearish market territory, and then it took 5 months for it to recover. So I think a lot of times when it comes to investing, whether it's the stock market, which I'm talking more specifically, the S&P 500 is an index within the stock market, it's all about patience, and it's all about understanding no matter what asset class you're looking at, you have to look at history and understand that we've been here before. Those are things to keep in mind. But when we see market volatility and when we see that the economy is on a downward trend, it's not a bad thing, and this is part of the cycle. And we have to understand when it comes to market cycles, things are going to go up and they're going to go down. But the biggest thing that we can do is just stay invested and not be afraid and not be fearful, because that's what, when we look at different media, when we see different things with them trying to control the narrative, we have to know that a lot of times there's people in the media that's controlling the narrative, that's managing money, and they want to do what they can to try to get you to sell a stock or to buy an overvalued position. So you got to always do your research, and you got to make sure that you're taking the time to make sure that you're putting your financial education first. And I wanted to just show you all this chart briefly, which is with Invesco. They show the bear and bull markets, the historical trends. And just to explain what a bull market is for those that may be watching my content for the first time, and this is all new to you, when you have a bull market, typically this is a stock market rise of at least 20% from its previous low. And when you have a bear market, this is when a stock has fallen at least 20% from its previous high. So when you hear people on TV, even when you read stuff online, it's a bull market, it's a bearish market, that's what they mean when it comes to that. Now, just some historical facts that they have here. They measured just the recovery. They're looking at the bearish moments we had in history as well as the bullish moments, and they dated this all the way back to 1957 all the way to 2018. And the average gain in the bull market was 153.71%. The average length of the bull market was 55 months. Average loss in the bear market was negative 34.33%, and the average length of a bear market was only 11 months. So that just goes to show you that the time in the market is the most important thing that you can do as an investor. When you rush to safety, or if you're running to cash because you are nervous of the volatility in the market, you don't necessarily want to do that, because we already know with inflation, the purchasing power of our dollars are devaluing, each and every day. So we have to make sure that we are managing risk appropriately, but we're still staying invested, and we are having a long-term perspective when it comes to this market. Because as you can see from this chart with history, a lot of times, most of the times, the market is going to recover, and the recessions are part of the cycle. So I just wanted to share you all just some positivity with this video, and just highlight that, look at history. When we see volatility, the first half of this year was the toughest that we have seen in some time across all of the major indexes within the stock market. The Dow has had, worst first half in almost a decade, since 2008. And, everything has been tremendously, volatile. But I think we got to just stay invested, and we got to understand that when we can look at history, it can show us a lot of things to know that these are clues of knowing that we've been here before. Let's be patient, let's be calm, let's be clear-minded, open-minded, and let's pick our spots and be able to pick opportunities when it comes to investing for the long term. And a lot of times when it comes to just investing in a bear market, you have to also implement other strategies. You have to be a skilled investor. So, looking at inverse ETFs, which are ETFs that will work in the opposite direction of an index, of a stock. Or you can look at, buying put options, where put options is simply you have the right to sell a stock at a fixed price. It's an option contract that you have, and you are making an intuitive decision that that particular stock or index is going to go down. So put options is a great way to be able to generate income within the bearish market. Of course, you have short selling, but all of those are strategies. But I thank you all so much for watching this video. Continue to like, subscribe, and share. Continue to share with your family and friends. And if you can hit that notification bell below the screen, you'll be notified every week when I drop content. And thank you all for watching another episode, and take care.